Welcome to our video, How to Diversify Your Investment Portfolio Effectively, H3, an in-depth guide to understanding the art of diversification and maximizing your returns. Hello and welcome to our video on how to diversify your investment portfolio effectively. In today's volatile and ever-changing market, it's crucial to understand the importance of diversification to mitigate risk and optimize your investment returns. Diversification is a strategy that involves spreading your investments across a wide range of assets to reduce the impact of individual investments on your overall portfolio performance. Throughout this video, we will discuss various strategies and techniques to effectively diversify your investment portfolio, key considerations while constructing a diversified portfolio, and the potential benefits it can bring to your overall investment strategy. Why diversification matters. Diversification is the key to reducing the impact of market volatility on your investments. By diversifying your portfolio, you can potentially minimize losses and maximize overall returns. When you have a diversified portfolio, you spread your investments across different asset classes such as stocks, bonds, real estate, and commodities. This diversification helps to reduce the risk associated with a specific asset class or market sector. Benefits of diversification include lowering the correlation between your investments, managing risk by reducing exposure to individual investments, and increasing the potential for consistent returns. Strategies for effective diversification. There are several effective strategies and techniques to diversify your investment portfolio. 1. Asset class diversification. Asset class diversification involves allocating your investments across different asset classes, such as stocks, bonds, cash, and alternative investments like real estate or commodities. One key principle of asset class diversification is that different asset classes tend to perform differently under different market conditions. By investing across various asset classes, you can potentially offset losses in one asset class with gains in another. Depending on your risk tolerance, investment goals, and time horizon, you can determine the optimal allocation across different asset classes for your portfolio. 2. Geographical diversification. Geographical diversification involves investing in different countries or regions to reduce exposure to country-specific risks and take advantage of global investment opportunities. By diversifying across different geographic regions, you can potentially benefit from the growth of economies in different parts of the world, while reducing the impact of local economic factors on your investments. Investing in international markets can provide access to a broader range of industries, companies, and currencies, thus reducing the risk of overconcentration in a single market. 3. Sector diversification. Sector diversification involves investing in different industry sectors, such as technology, healthcare, finance, or consumer goods. Each sector has its own unique characteristics and performance drivers. By diversifying across sectors, you can reduce the impact of sector-specific risks and take advantage of opportunities in various industries. However, it is important to conduct thorough research and analysis before investing in specific sectors to understand the associated risks and potential rewards. 4. Individual investment diversification. Individual investment diversification involves spreading your investments within each asset class or sector. One common approach is to invest in a diversified mix of individual stocks, bonds, or mutual funds within each asset class to reduce the impact of any single investment on your portfolio. By diversifying within each asset class, you can mitigate the risk of significant losses in case a single investment underperforms. Constructing a diversified portfolio. Constructing a diversified portfolio involves considering various factors to ensure an optimal mix of investments. 1. Risk tolerance and investment goals. It is essential to understand your risk tolerance and investment goals before constructing a diversified portfolio. Different individuals have different risk tolerances and goals. By aligning your investments with your risk tolerance and investment objectives, you can create a portfolio that suits your unique needs. Conservative investors usually opt for a higher allocation towards bonds or cash, while aggressive investors may prefer a larger allocation towards stocks or alternative investments. 2. Asset allocation. Asset allocation refers to the distribution of your investments across different asset classes. Choosing the right asset allocation is crucial. It should be based on a thorough analysis of your risk tolerance, investment goals, and market conditions. Diversification through asset allocation can help manage risk and optimize returns by reducing overexposure to a particular asset class. 3. Periodic review and rebalancing. Once you have constructed a diversified portfolio, it is essential to periodically review and rebalance it. Market conditions and asset performance can shift over time. By regularly reviewing your portfolio and rebalancing it, you can ensure that your investments align with your desired asset allocation. Rebalancing involves adjusting the portfolio's allocation back to the intended levels, considering changes in the value of investments and the original asset allocation strategy. Conclusion: maximizing your investment returns through effective diversification. Diversifying your investment portfolio is an essential strategy to minimize risk and maximize returns. By spreading your investments across different asset classes, geographic regions, sectors, and individual investments, you can potentially reduce the impact of market volatility on your overall portfolio performance. Remember to align your investments with your risk tolerance and investment goals, regularly review and rebalance your portfolio, and seek professional advice if needed. By mastering the art of effective diversification, you can enhance your investment strategy and work towards achieving your financial goals with confidence.